We got some strong results from big companies, but still smaller stocks looking shaky. What should investors do here?
Right, and I think you got to be cautious right now. We've had a decent April. I think S&P up about 120 basis points on the month. But when you look at it, what's going to be our catalyst going forward? I think we're going to turn attention to the Fed, and I think reality is going to come back and slap these markets back down. We are hitting this 4150, 4200. We've stalled out here 2-3 times in the past, and so I think it's unlikely with the bulk of the mega cap earnings behind us and how much of the cap has reported. Yes, we have another busy earnings week next week, and we have Fed week. I think you're just set up that I think it's a little more probable we could see some near-term downside just because I think the Fed is going to have to fight inflation. They look at the banking system. I think it's stable enough, even if First Republic goes down. But the Fed and interest rates and maybe not a pause after May is going to be difficult.
Well, we got some interesting consumer names, Matt, coming up early in the week. Tuesday, we got Starbucks, Marriott, Molson Coors, which is interesting because beer is interesting these days, perhaps some share gains to be had there. And then Zimmer Biomet, we heard from Boston Scientific this week, the returns to elective procedures might be positive for them. What do those reads tell us early in the week?
So I think you can extrapolate a little bit from what we've already received thus far from a lot of consumer-related names, and that's earnings haven't been as bad as feared. You know, the economy has held up much better than I think a lot of folks have feared, and the consumer wallet is still open. So I would expect that discretionary spending on coffee, people continuing to go back to work, I think all of that plays very well for companies like a Starbucks, and healthcare has been a part of the market that I like a lot, because it's more defensive in nature, but it still has impounded growth characteristics. And when you look at areas that have worked fairly well, equipment names are levered to more elective procedures. So I think there could be some upside from those names. But within healthcare, I still prefer the HMOs. I prefer healthcare, service companies and pharmaceuticals simply because of the expanding market. Aging population, I think there's a lot of long-term secular growth trends that support those names, but I would expect earnings to be fairly positive from them. But again, like Victoria said, the Fed is going to be the big question mark, and I fully expect 25 basis points and higher for longer to continue to be pushed by them.
Yeah, so what about that, Victoria? Because the consumer is still spending. That's great in the near term, but for those who expect the Fed to be cutting at the end of the year, the case for that looks tough to me after this week's earnings. And if you then do have to factor in higher rates for a longer period of time, A, do more things break? B, do you have to kind of shift where you think you see opportunities in stocks?
I think you want to be focused again on short duration, whether it's short duration on the fixed income or the equity side. You want to focus on quality and cash flows, because this disconnect that we have between a pause versus a cut and then the Fed, I really think is going to be reluctant unless we see recontagion in the banking sector, then you should see them stay higher for longer, which is going to be a headwind. It's going to slow lending. You have slower lending there. You have tightening conditions from the bank, but those things take time. And so if you look at what the yield curve is telling you, it's, I think, pricing at 90% likelihood of a recession. It does look like a bit of a car crash coming in the second half. I agree. Earnings have been stable. The consumer had just continued to weather. We keep thinking the consumer is going to break. Now spending is going to slow, but we get more and more data that consumers continue to spend, and those staples and discretionary, especially discretionary at Chipotle and McDonald's and Domino's, all saying the consumer is spending. We are seeing changes in behavior. Both McDonald's both Chipotle and Domino's said less delivery, more eating in because they don't want to pay the delivery fee. So maybe we are seeing some consumers start to look to save money. But for now, these sectors have remained extremely resilient, and we haven't seen the boogeyman come out in Q1 earnings.